Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I am joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. And in this episode, we're going to cover the latest news around energy and minerals and royalties for June of 2024. And Justin, there's a mix of court cases here, merger updates, forecast for gas and oil, and we'll dive into all of that. But in my mind, there's more to just the headlines if you read into it a little bit more, and we'll dive into what we think about those things.
You said it, man. Yeah, there's some really interesting stories coming out, and there's some things we've talked about before, and just kind of a follow-up and play out of those. And as you said, some of these stories allude to maybe something a little bit different than we're reading on the surface here. So our first one, Matt, speaking of that, the article here is the Colorado Supreme Court clarifies who owns oil and gas beneath streets. The Colorado Supreme Court on Monday, citing a need to avoid mass litigation across the state, ruled for the first time that property owners generally retain the mineral rights under roadways adjacent to their land up to the center line. The decision resolved the question of who is entitled to oil and gas royalties that occurs beneath right-of-way when a deed transferring that ownership is silent about the mineral rights. And Matt, as you mentioned, this story is pretty interesting. It kind of shows how the Colorado Supreme Court is handling mineral right ownership and their opinion on it. And long story short, it sounds like they ruled that the mineral owner would own that up to the center line, and it kind of avoids having to do massive amounts of title work on these tiny strips of right-of-way land.
Yeah, I think it was very pragmatic. I think it's the right decision. And you mentioned a good point before we hit record that it really just upholds the center line presumption, which is basically that concept of the mineral owner owning underneath the roadway up to the center line of the roadway. You know, if you think about it, like historically where you had a parcel of land before they put a roadway in, you owned up to the edge of that parcel. And then when they decided to, through eminent domain, oftentimes, get an easement or get that strip of land for the road, usually the state really only needs the surface in order to put the road in and the drainage and all those things that go along with it. And so if you think about where that old outline of that previous tract was going up to the center line of the road, it totally makes sense that the mineral owner should continue to own that after the road is put in. And I think that's exactly what the Supreme Court had ruled in this case. And I think in most other states, that's sort of the standard as well, that you own the minerals up to the center line of the road. And that is exactly what they said. And it was interesting that they cited the need to avoid mass litigation across the state as a reasoning or one of the reasons for their ruling. And in my mind, this really was an interesting insight into what the current Colorado Supreme Court, what their thought process is around property rights in general. And, if we think about some of the other regulations that have been proposed, and there would have been maybe a potential takings claim. We've talked about that in a couple of episodes, and we'll link to the latest episode we did on that topic in depth in the show notes, so you can listen to that if you haven't already. But essentially, to me, it indicates that, well, if there were legislation to be passed that would prevent mineral owners from enjoying the financial benefit of their property, that I could see the Supreme Court overturning that legislation, from the same standpoint of citing the need to avoid mass litigation from the litany of mineral owners that would be affected by that legislation. So really interesting insight into their thought process, and hopefully it would be something where they would uphold private property rights. If we got to that point where there was some legislation that prevented us from, seeing our minerals drilled, to produce oil and gas, then that potentially that they would uphold the mineral owners' rights in that case. But, reading a lot into what, this is a fairly minor, I suppose this is a maybe a little bit unrelated case, but, kind of interesting. If you read the tea leaves, maybe that is a positive for mineral and royalty owners. And either way, I think it's a benefit for mineral and royalty owners, because it means that we continue to enjoy the benefits of owning the minerals under that road and continue to get royalties from that.
You said it, and good to see that they've kind of upheld the precedents here with the way it's been handled in the past. It keeps from shaking things up and kind of keeps it consistent. And, Matt, this is really an outcome of looking at this because of hydraulic fracturing and horizontal drilling. In the days where it was all vertical, this was much less of a thing, but, it's easy to access those minerals now from a distance away, where in the past that wasn't the case.
Yeah, that's right.
All right, Matt. So the next one here, U.S. shale mergers could bring steadier oil prices. The article goes on to say that the key driver of the industry now is returning more to shareholders and preparing for inventory stacked up for years of production ahead. Last week, the U.S. oil industry saw its latest announcement of a big merger after ConocoPhillips said it had agreed to buy Marathon Oil. The deal value so far this year has already surpassed the total deal value of $69 billion recorded for the entire first half of 2023. We've been hearing this story about merger mania in the industry, and it continues to go on. And as the article mentions, ConocoPhillips agreed to buy Marathon Oil in late May, $22.5 billion deal. And it'll make the largest Eagle Ford producer, one of the top 3 Bakken producers, and they'll still be one of the top Permian producers. The article goes on to say that most of the activity has been in the Permian Basin, but we can expect to see more activity outside of the Permian Basin in the coming year.
Yeah, I think that was interesting that they are indicating, what might happen with some of these other companies that haven't come to the table yet. And they mentioned specifically an article that Financial Times wrote recently that mentions EOG and Devon Energy as 2 of the largest publicly traded companies that haven't been part of this recent deal making. So we'll have to watch and see what they do this year. I think the indication is that most companies are going to want to do some sort of deal so they don't get left behind because of the economies of scale. These larger producers are going to leave everyone else in the dust, at least in the larger independent oil and gas companies. So if you're left behind and not doing a deal and kind of increasing your scope and giving you more running room to continue to drill and more reserves and more drilling locations, that could be negative for those companies that are left behind. So I think it will be interesting to see those companies that haven't done a deal yet. I would expect there's going to be something happen later this year. And it did mention that the Permian is pretty well picked over, not a whole lot of other opportunities there, that are strategic to some of these companies where, there's an operator that's adjacent that if they bought it, they would have contiguous acreage and things like that. So they're looking elsewhere in other basins where maybe the prices aren't as bid up and as high as in the Permian. So we'll see what happens there. The real takeaway that they mentioned was that as producers become bigger, they focus on shareholder returns. It wouldn't be inclined to respond to every price spike with a major boost in drilling that ultimately floods the market with oil and depressed prices. So whether that theory plays out, we'll see. But I think it's an interesting one to think that as more producer consolidation occurs, they are continued focus on shareholder returns. These are publicly traded companies. The way that they return value to shareholders is through stock buybacks and dividends, and they're continuing to reinvest in those 2 things instead of pouring all of that money back into drilling new wells. What we saw in the past, you have this boom and bust cycle, which is largely the result of oversupply during high prices, which causes prices to crash. And then producers cut back, decrease drilling. That causes production to fall. And then supply and demand get back in balance. And then sometimes goes back into demand exceeding supply, which causes price to go up again. And that's that rinse and repeat cycle of, continuing to increase activity, reinvestment into drilling new wells and increasing production during high prices. And now we're sort of seeing that sort of stabilize. And even with the oil prices responding and coming back up to near $80 a barrel, companies are not increasing spending. They're sort of maintaining it flat from where they were last year. And so it's interesting to see that occurring, and whether or not, that helps to stabilize prices. We'll have to see, because you got to keep in mind that this is a global commodity. There's a lot more that plays into it than just large U.S. publicly traded producers and what they're doing. And, you have all the OPEC countries, you have the macroeconomic, outlook, and whether or not we're going to go into recession or our economy is growing and demand is increasing for oil and gas. And so all of those things play into it. So maybe they're putting too much stock into publicly traded companies, no pun intended, but I think it'll be interesting to see how it plays out for sure.
You said it, man. Yeah. And like you said, they're really focusing on returns to their investors rather than that boom or bust cycle. And, at this time, all of the other operators or all of the other big players are really going to be trying to grow to match some of these mergers and acquisitions. Nobody wants to get left behind as the new small operator here. So be interesting to see how that activity continues.
Yeah, it will be. Okay, so the next one here is really interesting because it talks about natural gas demand. So we mentioned a little bit about the oil side of things, but the EIA just recently released its short-term energy forecast, and they are forecasting that our U.S. summer natural gas consumption forecast matches our 2023 record. And so the EIA forecasts that the natural gas consumed for electricity generation this summer in the United States will reach near the record set last year. Despite a 3% increase in overall U.S. electricity generation this summer, we do not expect natural gas consumption for electricity generation to grow. Growth in electricity generation will be largely driven by increased renewable energy production. So I thought that was an interesting statement, Justin, that they're seeing that natural gas is remaining flat. The increase in capacity is coming from renewables, which I guess is pretty consistent with that energy transition deep dive that we did a couple of weeks ago, which again, we'll link to in the show notes. We have lots of charts in the video that accompanies that episode, so be sure to check that out. It has a lot of data behind what might happen there, but we're looking at 44.7 BCF per day, and that's billion cubic feet per day, is the natural gas consumption forecast for electricity generation. And that is the average that's expected from June through August. And that's a lot of natural gas, Justin.
It's a whole lot of natural gas. And we were talking a little bit before we hit record here on the show, Matt, but it really kind of highlights the parallels to moving forward with renewables and the continued use of natural gas to secure that and ensure that we have that scalability and the ability to react quickly. And not a whole lot of change. So there's some decrease in coal usage here, not a lot of change in nuclear. It really looks like renewables and natural gas growth is going to be the focus. And glad to see that renewables are up and that we've come to terms with natural gas being the companion to that transition.
Yeah, that's a great way to put it. And you have to have a source of energy that is reliable and is something you turn up and down pretty quickly. And natural gas fits that bill perfectly. So their report mentions that as electric generation capacity from renewable sources grows, natural gas is used to increasingly balance the intermittent nature of electricity produced from wind and solar. And they said that electricity generation since 2014, which is the beginning of when we really were ramping up drilling and sort of this shale revolution. And so there was a lot more natural gas coming online, and we were shifting pretty rapidly from coal to natural gas. And as a result, the share of U.S. electricity generation from natural gas in the summer increased almost every year except 2021. And it increased from 29% of the capacity in 2014 to 46% in 2023. And I think, part of that story, to your point, is the fact that we're building out so much renewable energy infrastructure in terms of wind and solar, and you need to have increased capacity to go along with that so that when the sun isn't shining or the wind isn't blowing, you can still produce electricity to meet demand. And that is almost exclusively coming from natural gas.
You said it. And it'll be really interesting to see over the next, 10 years if nuclear starts to play more of a role in this. And we've talked in some of our previous shows, Matt, about, how much opportunity there is with nuclear and some of the new technology coming out. So it'll be really interesting to see if we kind of make that shift. And I know on the opposing side of the table, folks would like to see the use of natural gas go down. And at least in my mind, the way out of that's going to be nuclear, which doesn't seem to be making a lot of strides right now, at least.
Yeah, hopefully it will continue to grow as we expect it to. And I think that's really the only way forward. If we're really that focused on decarbonization, that nuclear has got to play a huge role. And we really dive into that again in that energy transition episode that we recorded a couple of weeks ago. So, all right, Justin, OPEC met this weekend. There were no changes announced, so that's not too big of a surprise. I think that all of the analysts were forecasting that they would maintain their voluntary cuts of 2.2 million barrels per day that were announced last November. And this weekend, they extended that until the end of September of 2024. And then they said that the 2.2 million barrels per day cut will be gradually phased out on a monthly basis until the end of September of 2025 to support market stability. And so I'm sure that something will change between now and then. I would not be surprised at all if they just continue to hold these cuts. Just totally depends, I think, on what oil prices do. But as long as they're right around that mid 70s, low 80s, I think it seems like they're pretty comfortable with that, and they would like to see that stay in that range. And if they were to phase out these cuts, then I think that could put some downward pressure on oil prices. Interesting that oil prices were down pretty significantly today, the first trading day following that meeting. So oil is down about $2.50 today, Monday, June 3rd. So Justin, I thought it was interesting that the market didn't seem to really pay much attention to that or really think it was going to help support prices, I guess.
You said it, Matt. Yeah, it really seems like business as usual for them, and we'll see if there's any major changes that happen that really kind of adjust OPEC's thinking on this. But I'm sure that they'll kind of maintain the cuts in an effort to keep it stable. And I know producers are trying to do that as well. So I'm sure there is some comfort in the industry about that, and everyone would like to see them maintain prices. But yeah, no, it'll be interesting, Matt, to see. I'm sure they'll maintain prices, and stability would be great. It'll allow the companies to kind of grow at a safe pace and help the pocketbooks of Americans and the world with the price of oil.
Yeah, I think that would be good. And like we see a lot of times, it's really interesting that oil and gas don't always move together. Whether one is going up or down, the other one tends to maybe do something different. Case in point today, natural gas is up around 1.7% to around $2.60 per MMBTU. So I'm glad to see natural gas prices recovering, pretty much erasing those losses we saw at the beginning of the year. So it's kind of back to business as usual for gas. And I think that EIA report should help support gas prices this summer. Forecasting demand to be high for natural gas for electricity generation should help natural gas prices this summer. And that would get us almost to the end of 2024. And then hopefully with extra LNG export capacity coming online next year, that we'll start to see prices go back up a little bit. But, related to that, let's talk about the rig count and where we're seeing a shift between oil and gas drilling, and which states and basins, Justin, that are seeing the continued focus and where we're maybe headed from here.
Yeah, man, I thought the rig count was pretty interesting here. So we're down one land rig over last week, and then we are up one gas rig, and then down one oil rig. And Matt, looking at the numbers here and how they break out as far as the different the basins. So Permian's down 2 rigs. We're down 4 rigs in the Woodford, up one in Marcellus, and up one in the Eagle Ford. And this is kind of the first time that we've seen a change in just consistently where we're losing and gaining rigs. So I thought that was a pretty interesting play out here.
Yeah, it seems like companies are just shifting things around, only down 1 rig week to week. So that is a good story. But, if you think about where we were a year ago, we were at 674 rigs, where we're down almost 100 rigs from a year ago. So we've seen a pretty steady decline in drilling pace. And, again, I think that was what we expected with 2022. We entered last year at a kind of a high in terms of oil prices, and activity was up pretty high. And as prices fell last year, we saw activity go down, as you'd expect, when it really is just totally dependent on economics. Obviously, capital budgeting goes into this, and that is sort of on a lag on a quarterly basis. So they'll plan ahead, and they'll, decide what they're going to do and give guidance for that quarter. And if prices fall within that quarter, they don't usually respond immediately. It may be a quarter or so before they will decide to maybe reduce spending and, adjust their forecast for the remainder of the year. And that'll trickle down into the rig count. And usually it takes some time, just because these are on long-term contracts, these rigs. They have, a certain number of rigs that they budget to run for the year. And then, it's usually pretty far ahead that they'll decide, okay, we're going to drop a rig, in the month of June, let's say, and decide to hold it steady from there. And then if prices go up significantly, they may pick up a rig again before the end of the year, but it's not something that it's going to be very quick to happen. So long story short, I think we're seeing the impact of the prices going down last year and, that sort of very slow and steady decline over time, a refocus on more oil drilling, 496 rigs drilling for oil this week versus 100 drilling for gas. And that makes total sense when you think about how low gas prices are right now relative to historically. And then even especially the last 3 months, gas was near, decades low prices. And so, drilling new wells at those low prices, you're not going to break even. You're not going to make money, but let alone break even. And so I think that's why you're seeing a shift to oil drilling. And then hopefully with gas prices recovering and stabilizing, we'll see that gas rig count start to pick back up slowly. But it shouldn't be something we'd expect to see happen very quickly. And I think it's really interesting with the gas side of things. It's pretty well focused on, in my mind, couple different areas. Louisiana being kind of the biggest with the Haynesville. Texas also is part of that in East Texas, natural gas focused. Pennsylvania, almost solely natural gas focused. Ohio, pretty heavily gas and a little bit of liquids and oil focused. West Virginia, gas as well. So you see these states that in this rig count, West Virginia with 6 rigs. You have Pennsylvania with 22. You have Oklahoma with 42. It's probably evenly split between oil and gas. And then Louisiana, 42. And there's your 100 rigs, basically, in those few states. The rest of it, Permian is primarily oil. Utah, primarily oil. Wyoming is primarily oil. Colorado, primarily oil. As far as the drilling goes, New Mexico, primarily oil. So, Texas, of course, with the Permian, most of that is oil as well. There's a lot of associated gas, but with the main focus being oil in those cases. A lot more states that are seeing oil drilling, a lot more spread out in terms of different basins seeing oil drilling. Gas is very focused on, in my mind, you have the Woodford, you have the Haynesville, you have the Marcellus up in the Appalachia Basin, and then also to a certain extent the Utica in Ohio and things like that, West Virginia. So, pretty interesting to see where we're at. Again, it's pretty much week to week. Don't expect big changes, but if you look at that trend over time, again, we've dropped 100 rigs over the past year or so. Hopefully it'll stabilize here soon, but because as we've said, multiple times, we need to continue to drill new wells in order to just maintain production flat, not growing production. So I think that's what's reflected in the rig count here is we're just sort of pretty stable on the production. The only state or basin that's seeing any kind of production growth is the Permian Basin. Everyone else is pretty much in maintenance mode right now. So
you said it, man. Very interesting to see. And we've talked some recently about lithium. So it'll be interesting to see over the next 2 to 5 years, what is the lithium production or drilling lithium wells end up doing for activity, whether it's the drilling crews or so on and so forth, because that could have a major change in the amount of activity that's spread out. Maybe we wouldn't see it here, but, interesting to see if that starts to be more common or something we hear a lot more about.
Yeah, that's a great point. And we'll have to feature that. I saw an article that was very interesting recently about lithium in particular from one of these large natural gas plays that we just mentioned. And so I think we'll plan on doing a deep dive on that later this year. So definitely stay tuned to that. But that was interesting because it's an area that has not really previously been discussed in terms of being a source of lithium. We've talked a lot about East Texas and Arkansas and the Smackover Formation, but there's a lot of other potential out there. So we'll be sure to cover that and to give you a little bit more insight and to understand whether or not you may stand to benefit from the increased lithium production with your minerals. So with that, thanks again for listening. As always, we'll link to the articles we mentioned in the show notes, which can be found at mineralrightspodcast.com. And thanks again, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.